What is for sure is disciples of Milton Friedman have been having a field day the past 6 to 9 months, because that enormous growth in the red line has led to, or certainly contributed, a very significant rise in things that you used to talk about in the early days of my career, 30 years plus back, money supply. Because in many parts of the developed world, monetary growth has been rising sharply. And historically, fast monetary growth has led to all sorts of things, faster than trend rate of economic growth, faster inflation, and for a period, rising stock markets. So it is pretty consistent with what's happened, that's for sure.
And you noted in your latest piece that you put out, you talk about monetary policy, you talk about flattening yield curves as well. We have seen, I mean, I know this is going to sound weird to a lot of our viewers that are maybe new to the financial markets. The move in the bond market in just 3 weeks has been pretty spectacular by bond market standards. And I don't use spectacular necessarily in a good way. What do you make of this sort of ultra tightening in just 3 weeks, Jim?
So again, unless your viewers and participants of a similar vintage, let's call it, to myself, and were around in 1993, 94, they won't have been particularly familiar with something like the past 3 weeks. But that period was literally, of the past 35 years, the only severe sustained multi-week move in bond markets that has existed in a negative sense. And we've had 3 weeks of a version of the same. And if this were to go on to repeat exactly 1994, then we would have a bit of a horror show coming in the financial markets, and especially given the very high levels of valuations that the equity market started off. I mean, in many ways, it's, as I wrote in that piece at Project Syndicate a couple of weeks back, it's almost classic circumstances of people that came, like myself, out of that era. And it's partly because the markets aren't really unsure of what the Fed's real mission on inflation is. And of course, as you're focusing on throughout the show, almost daily, I'm sure, the past few days, quite how far the Fed going to go. And your colleague didn't touch on this part of Biden's comments yesterday, but to my eyes and ears, he gave a not so subtle nudge to get a move on and raise rates to the Fed, which is, of course, in many ways quite remarkable coming from a Democratic president. But, you know, the issue all over the Western world is trying to get inflation under control. And so there's not this huge threat to real income growth as well. So it's all quite concerning.
I would like to say the great minds think alike, Jim, but yours is far greater than mine. But actually, last night, I tweeted out that maybe one of the greater market risks that nobody paid attention to in that conference was exactly that he basically deferred to the Fed. He said, well, fighting inflation is the Fed's job. And I wondered, I was like, wow, my eyes kind of popped. And I thought, he just gave Jay Powell and the Fed the political open door to sort of do whatever it wants on inflation. Did he not?
I think he did. That's how I read it. And we're seeing the same thing here in the UK. The British finance minister, or the chancellor as we call it, has been, getting onto the media because we had very high inflation figures reported here again. And he essentially gave cover to the Bank of England to raise rates. And of course, at a time where there is fiscal tightening going on at the margin after the admittedly mammoth stimulus of the past 2 years, this is possibly why yield curves are starting to flatten a bit, and equity markets showing some concern, because tightening monetary and fiscal conditions at the same time aren't usually known as being particularly good recipes for sustained economic growth. So there's lots of tricky things here that the markets are having to deal with.
And the rate hike forecasts are all over the map, from a couple, 2 or 3, to I think somebody from JP Morgan had 8 or 9 mentioned the other day.
Wow.
Let me go back to a previous thing you said earlier, Jim, which was horror show, which of course makes me think of A Clockwork Orange. But you said it's going to be a horror show for certain parts of the equity market, and I think it already has in many ways, especially with money-losing companies, stocks trading at 100 times projected because they have no earnings, projected results, or whatever metric you may want to use. Is there any reason to own those companies now? Because in 1995, and I'm getting up there too, my friend, 1995, the Dow rose 33%, even after a bunch of rate hikes, but high multiple companies got hit.
Yeah. You know, I think in that sense, as I'm sure there is evidence of it, for true equity sector pickers and specific stock players, you know, this is one of the most interesting times and actual opportunities, I would guess, that we've seen for quite a long time. And for real experienced market players, this should be a great opportunity to prove that you can give alpha, because we've had for, you know, most of the years of the past 12 years, essentially highly correlated markets that have indeed all been down to extreme monetary and fiscal generosity. And if we're now starting to come out of this pandemic into an endemic stage, which is increasingly the mood over here in Europe, by the way, and we're going to see more natural economic growth recovering as well, you know, the policymakers do not need to continue with the emergency type policy support, even if inflation stabilizes. You know, we need at one point to get back to a world where there's a positive real interest rate, and that will mean some of these enormous gains that we've seen in certain parts of financial assets, perhaps including things like crypto, certainly blockchain and some of these others, are going to have further corrections, because a lot of them are just based on huge amounts of monetary growth. And the key for real stock players is to note the difference between those with a sustainable business plan and those that don't.